If you can get those two parts of the business filled by a good person from day one, you're going to make a lot of money very, very quickly versus if you're one person trying to do it yourself. What is going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. Today is Wednesday. It's the Off Market Operator Show. And if this is your first time here, this is the show where we teach you to make massive income, not just passive income with your real estate investing business. I am Mike DeHaan here with my co-host Dan Austin and Dylan Cook. And on these Wednesday shows, we talk about the real estate world in general, kind of like more macroeconomic stuff. And then today specifically, we are actually going to be doing a little more focused conversation and talking specifically around partnerships and business partnerships and sort of like when you should have them, when they make sense, the pros and cons, primarily because we work with a lot of newer people, I would say like growing investors through our scale community or talking on social media or different things. And partnership seems to be one of the most recurring questions and themes that comes up in what people ask us about, or, you know, some of the areas where people get caught up seems to be around partnerships. So we wanted to do an episode just to go over kind of our thoughts, when they make sense, when they don't. And that way you can maybe make a little more of an informed decision before you go and sign the dotted line with somebody that might not be a good fit. Mm-hmm. So would you guys want to start with this? I know, Dylan, you've brought this one up for a little bit. It's something that you wanted to explore. I guess, what's your rationale outside of what I just said around you wanting specifically to dive into this one?
Yeah, like most newer people that they get started, they view partnerships, I think, as like a safety blanket. And even when I first started, you know, you didn't have a lot of assets, didn't have a lot of net worth. And so I did have a partnership at the beginning of my investing career, and we scaled kind of quickly. You know, relatively, we had 13 units after like 6 months. And it was all the buy and hold method. It wasn't really like wholesaling or flipping at that point in time. But as things kind of went on, you know, we kind of drifted in separate ways and we had different goals and aspirations. And so that partnership ended up splitting. And the lessons that I took from that is, one, you know, always have, like, in the beginning, get your operating agreement signed up to how things are going to be split if things do go sideways, for one, because you don't have to try to negotiate that on bad terms when it's ending. Mm-hmm. And then two, have complementary skill sets, which I know is like cliche, but we were so much alike that we were just doing the same shit. And we disliked doing the same stuff too. So like there was nothing that was complementary other than like, you do it this day and I'll do it the different day. Sure. So I don't know. That's my take. I feel like I could have done things a lot better at the beginning. And I don't, now that I've built something to this point now, like kind of by myself, I would be a lot less hesitant to bring on a 50-50 partner in today's, like in my business today, because I built this from the ground up. So someone would have to bring a lot of value for me to do something like that.
Mm-hmm. Yeah. And so you have some good wisdom there for like how things ended. Let's start with this though. So Dan and I, we partnered up originally because we had slightly different skill sets. Also too,
probably had a mutual need. We probably had a need that was probably, we both had gaps that would have been filled easily right then and there.
Correct. Right. And like I had already been pretty involved in like the flipping world at like a larger level. I'd really been diving into systems and figuring that out. Dan had a lot of experience around the renovation and the property stabilization side, everything else. And then when we partnered up, we decided to do that because we also had similar goals at that point. So when you started up, Dylan, why did you choose to have that partnership? Was it because of a similar circumstance?
He was one of my closest friends at the time. We were both kind of starting on this journey together. So like the synergies were there. And honestly, it just felt safer. It felt easier, you know?
Yeah. See, and I think that's the trap that a lot of people fall into, which I would always say is the worst reason to have a partnership, is because it's your friend and you feel like it's going to be safer, more secure for some reason, which is funny because like as a more experienced person, you realize that that's kind of silly, right? Yeah. When no one has a track record, it's like, I don't know, the blind leading the blind. It's like two virgins having sex, right? Like, if neither of you have experience, you don't really know where things are going to lead next.
But you can still take each other's half of each other's net worth.
Yeah, exactly.
Well, that too. And the other caveat is like, we were at this time, at this point in our careers, we were both like graduating pharmacy school. And we had no intentions at this time to leave our W-2. So we were going to make $250K combined. So it was like, okay, we're going to have all this money that we can deploy into real estate. It was kind of like,
yeah. And so you were buy and hold strictly, like you mentioned,
at
you
the
weren't
very
trying to start
beginning.
a,
Yes.
Yeah. That to me doesn't make any sense to partner up if your intention is to build a single family or small multifamily portfolio, because you're basically taking on the exact same amount of risk. There's really it's not like the debt is half the risk. Yeah, technically you guys can split the debt up, but like technically you're both liable for all of the debt, and you're splitting up all the cash flow, and you're not splitting up the risk, in my opinion. And so then when you break up, you have this like weird, like, how do we split these assets up?
Dan, it's funny that you said, because you just made me remember something. You remember how, so the government will let you have 10 in your own personal name, 10 loans in your own personal name. So we would do like we'd each buy 10 and then quit claim those into the LLCs that we own together, so that we could get the 5% down or whatever it was financing at the time. But that was our beginning strategy.
And I mean, it's not a terrible idea. It's just like a lot of people you can't trust that well. It sounds like this person was at least trustworthy, your original partner. It's not like you guys like broke up because I mean, assuming that's why we haven't gotten to that part of your story, but it wasn't like you were ripping each other off.
No, 100%. Like he still is. And when it ended, he was still, a groomsman in my wedding, but I would be lying if I said our overall friendship wasn't affected by that ending.
Really? What was the cause of that?
He wanted to do more commercial type assets. I still wanted to do the single family, small multifamily. And not to get like too dive into it, but his like living dynamics were so much more different than mine. And so that I was starting to grow a family, like we're getting married, and there's just, we're going in separate ways pretty quickly on like the personal side, which then affected the business side.
Yeah. Goal misalignment, which is natural, like for things to grow, even like relationships with anybody you have, like your lives grow differently. And sometimes they still grow parallel, and like you can like have friendly relationships and you stay, but it's like, when do you have a friend throughout your life that you've really stuck with and have the exact same hobbies your entire career? Like that's just less likely.
Yeah. I think one of the hot takes is, I think partnerships are more likely to fail the younger you are when you get into them. I think if you're older and you're kind of set with what your business looks like, what your life looks like, they're less likely to fail at that point in time.
Yeah. I mean, I think that's yes and no. I mean, I would say age is one piece of it. I would say that your life experience is really what it comes down to, because I think if I have older people that are very immature in business, but their lives are very secure, they're probably still going to fail, just because they're going to have different reactions to the challenges that you face in business ownership, which are inevitable. And a lot of those things you don't necessarily learn until you face them. And so I guess just to bring this around sort of to keep it actionable too, is starting at the very beginning piece. Like when you're starting out and you're trying to decide if you should have a partner that's going to, be with you from day one, the main thing you should look at are, do you guys have mutual middle and long-term goals, not short-term goals? Everyone has the same short-term goals, is to make money, right? That's why like three guys can go out for drinks at a bar and come up with the best business idea that they're never actually going to do, right? Because that sounds awesome right now, but looking at like the 3, 5, 10-year goals, which realistically a business relationship, if it goes well, will last that long. Those should be aligned. Also making sure that you guys have different skill sets, but also making sure that you guys have the similar expectations around like how much time you're going to be willing to put in, how much money you're going to be willing to risk, right? What exactly you want your day-to-day to look like. Because Dan and I mean, we recently did a little business acquisition and we fired the partners that we were the previous owners. We bought into that because our expectations around what the day-to-day was meant to look like were very, very different. These guys wanted to work from, 9 to 4 and then go to the gym and then hang out. And then Dan and I are running another business, and we're also now managing this business that they were supposed to be in charge of. And so that didn't work out. And those little things are what cause most of the tension, because when you're starting out and everything's going well, it can feel easy. The problem is with partnerships is as soon as there's a little bit of friction, it's just like a marriage, right? As soon as a little bit of friction, it'll start to fester and it'll start to really get out of control very quickly. And like you said before, Dan, the problem is now it's like a financial burden essentially on both sides. If a partnership breaks up and one person's more well-to-do than the other, you have assets that are going to need to be split. And that can cause problems if you've made even like a most, mediocre amount of money.
Totally.
And so it's like starting out, that's a thing, something you need to realize. But I would say if you can find somebody, the power of a partnership is incredibly massive. Like most companies that private equity looks to invest in, they typically look for companies that are owned by partnerships, ideally 3 people, because that has been shown to, I would say, most equally align people's like energy and skill sets into the pillars they normally look for, which are usually, what are they? It's like sales and marketing, product development, and like
HR admin.
Yeah, like HR.
Yeah,
thank you, and like
right.
hiring.
Yeah.
And so when private equity is looking for these large companies, they typically want founders or leaders in the company that are established in those roles, because if you can get people in those silos and they're good at it, that's the recipe for companies to really, really do well. And I would say the same thing exists in a real estate business. When it's small, it's a little bit different, but you need someone that's good at like the acquisition portion, and you need someone that's actually good at like the project management or the disposition portion of it. And if you can get those 2 parts of the business filled by a good person from day one, you're going to make a lot of money very, very quickly versus if you're one person trying to do it yourself.
Totally. And it's hard to know, especially if you're new into an industry. It's like hard to know who's going to necessarily be a good partner. And I will say we get a lot of folks through the scale community or just, through social media, like talking about or asking questions about partnerships. Like one of the things I always tell people, and it's like 99% true all the time, do not partner with your contractor because they have the skill of swinging the hammer.
Totally.
There's a difference in being able to run projects and understand how to stabilize properties and being passionate and good at that than swinging a hammer. You can hire that. If you can, in my opinion, if you can hire it out right away, super easy, and it's a commodity like being a contractor, you probably shouldn't partner with a contractor. Now, if you're partnering with a contractor to do something like starting a contracting business, and part of that will be renovating your assets and your flips, that's a little bit different. But when you're like, well, I'll just split it 50-50. Well, guess what? Almost 100% of the time when people tell me they did that, the contractor charged them an hourly wage or a general contracting fee and then still wanted half the money at the end of it. And by the way, there usually isn't very much money because the contractor's milked you dry by that time and slow rolled your project. Even if they're a great guy and you're going into it, it just happens almost all the time. So when you're choosing the skill set, just because you don't know how to swing a hammer, you never need to know how to swing a hammer in this industry. Just don't use that reasoning to partner with a contractor. Now, if you have complementary skill sets, or there's something like another thing I see is people that don't have money want to bring a money partner in, which is great, but not usually in like a 50-50 true business entrepreneur standpoint, because the person with the money in a lot of these cases would be a better fit as a private lender and not necessarily somebody to fund the day-to-day operations of your business. Because let's be honest, I don't know about you guys, I don't know too many people that are willing to just give me money to burn on marketing and sales and staff and salaries and all that sort of stuff, right? When we're talking like wholesale and off-market real estate, that just doesn't happen. And then they're going to be looking over your shoulder. They're not going to bring any of the skill sets. They're just bringing money, and then they're going to demand more from you.
Yeah, and those are the 2 most common, I would say, air partnerships I see for new people. And that contractor one, I think that's mostly fueled by people's, I would say, like desire to avoid conflict, because they're afraid to like have to deal with the contractor, slightly different personalities.
True.
What happens if things don't go wrong? I don't have hard conversations, and that's that's easy to get around. When it comes to the money partnership, like you mentioned, where this is something that I regularly think about when I see these situations come up. And we've seen this come up with scale members and a lot of other people, but it always seems to be this weird power dynamic when it happens, where it's like a younger investor trying to build up their business, and they meet with like a older seasoned, veteran guy that's been in the industry for 30 years. And the guy goes, yeah, well, let's go and partner up on this. And, every single time I've heard this situation, I'm always like, bro, you realize that this old dude's fucking taking advantage of you, right? like he's positioning it from a thing of like mentorship. And I understand that you probably want to bring him value because he's provided knowledge for you. But for him to just like write you $100,000 check to flip this house and want 50% of the profits is an obscenely expensive way to start getting into doing deals, where you're better off just getting a hard money loan, paying a fixed rate, and you're going to keep a lot more of the profits. And the old guy knows that. Like he's not
trying to get
stupid.
good margin. He's smart.
Totally. And it's just like such a weird, like I would say a abuse of power almost, or abusive positioning by somebody that knows that they have leverage over this person. And so it's something to be really, really cautious of. Or even if it's not like necessarily like an older mentor, if you just have like a buddy who's like, hey, I'm rich, I own whatever company, I make X amount of money, and I want to like partner up with you on your business and get like 50% of the profits. If they're not going to bring any other skills besides money, do not work with them.
Don't do that.
You're going to be indebted to somebody that is going to have a lot more financial leverage if things go sideways and shit needs to hit the fan.
Totally. Well, I mean, don't most GCs, isn't a typical GC like 25-30% of the job? So just by the sheer math portion, you're losing out 15% of your overall profits just from partnering up instead of just hiring a GC.
Yeah, totally. Right. Yeah. Exactly. And it never works out. And I would look at the money person as the same thing as a contractor. And you can typically hire, and I'm saying that in quotations, the money, because hard money is actually not that hard to get in this business. And you can find private money. And I've had a lot of people like come up to me like, hey, I'd love to get involved. I'd love to, invest with you. I'm like, cool. It's, we're going to pay you a 9% flat rate on this, blah, 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 or whatever it is. And they're like, well, I thought we'd like partner in 50-50. I'm like, you bring nothing to me. Like I can get money, and I'm at a point now, obviously I have money to do the deals, and that's how we operate our business, but I can get the money. And it's a self-limiting belief that you can't get the money when you first start out. And I get it. It's a good belief because like you haven't done shit. So why should people give you money? But hard money lenders exist for this reason. They're going to charge you more. It's going to cost you a little bit more, but it's not going to cost you 50% of your deal.
Yeah. Yeah, totally. And I think there's this thing too, where people are like, oh, I'm going to be willing to partner with this person for 50% of the deal in case the deal like goes bad. Like they're like worried about like losing on it, but like that's a problematic way to view it. And if you realistically have concerns that you're going to lose on the deal, you probably shouldn't be buying it in general.
Yeah.
Right.
Totally.
Yeah. So it's a weird dynamic people get into.
So let's talk. I'll ask this question to both you guys. So you're an operator. You're kind of starting out. You're like, oh, I'm scared to spend money on marketing, but you're doing it, and you're just not seeing the growth you want. Maybe you're hitting a deal a month or a deal every couple months, and so you're like you're covering your costs, and maybe you suck at sales, or there's something that you're bad at. Do you hire or do you look for that partner?
Yeah. See, and that's always the key question is a lot of people go and try to find a partner to do that because they don't want to have to pay somebody, when realistically you can hire people for probably a lot cheaper than you think, right? Even like solid players. And that's realistically the route most people could go, because if you're bringing in a partner to say like do the acquisitions now, that's going to be probably one of the most expensive hires you can make, especially if you're giving them 50% of your company, when you could be paying them, if your business does well, like $100,000 a year.
Sure.
Right. Like if you're going to be
the ownership.
Exactly. Yeah. If you're going to be bringing in a partner like into something established like that, they need to be like multiplying your business at like kind of an exponential level. Otherwise it's not worth it at all.
1 + 1 is equal 3 kind of thing.
Exactly.
Totally.
Yeah. And it's funny. I've had this conversation at GoBundance events a couple of times now. I talked about this at KeysCon too, but I remember getting into kind of a debate with somebody about this. And they said, well, how come you partnered up with Dan then? Right. And I said, well, honestly, because I was the one that was kind of in need in that situation, because Dan had more financial leverage. Yeah, Dan got taken advantage of for sure. Because realistically, if Dan had decided that he had these goals, he'd say like, hey, I'm going to pay you $100,000 a year to basically do this for my business. At that point in my life, I would have done it for sure. Like I can guarantee it.
And I guess the argument on my behalf of why a partnership would have made sense at that time. Yeah, I had some financial stability compared to Mike, but I wasn't by far the rich guy or anything like that. And I had experience in real estate in my niche, and I knew exactly what I was laser focused on it. However, my growth goals did not align with what the market niche I was looking at would allow. Right there's a misalignment. I couldn't get to where I wanted to go faster. So Mike came in, and when we partnered, I was able to go a lot faster. I had to broaden and move outside of a niche. And now I don't even think I have what I would consider a niche other than residential real estate, right? We flip, we wholesale, we do all sorts of things. And so that for me was the 1 + 1 = 3, right? Because I could financially invest and then invest my time in our business, and I would get a lot further, a lot faster, which is exactly what happened.
Exactly. And I came in with less financial power, but significantly more time, which I was
Sure.
more than happy to bring. And so that balanced it out.
Yep.
But, you know, and the funny thing is too, is we didn't necessarily realize that at the time. Honestly, we just kind of got lucky that it worked out that way.
For sure. Yeah.
But a lot of people, they don't even, I don't know, they just don't get that fortunate, and it sort of starts to cause friction early.
Yeah. And I think from like the people who are listening to this, who might be like the outside perspective, a lot of the big social media people that I follow in this business who seem to have killer businesses are partnerships. You know, you and Dan, you know, I won't name drop a lot of people, but there's a lot of people. Billy and Tara, even Josh and Tiffany, like, you know, we hate on them. Like, there's a lot of people who have these quote unquote 7-figure businesses.
Pace and Jameel.
Yeah, there's all these people, man. Like, so I think that's kind of like the shiny object syndrome almost.
Yeah, exactly. I mean, totally. And what it's because when it works well, it, like we said before, it causes exponential returns. Yes. But the problem is it also has a lot of downside risk. And
Mike, I just want to share this story. There's a guy who's a local wholesaler in my market, and he actually did pretty well for himself. And we can sidetrack into what we talked about yesterday about how many deals you can do a month as a solo person. But anyway, he was doing a couple deals a month, making probably like 250, 300K a year. And then he got approached by somebody who owns like 300 something apartments. He's like, hey, why don't you work for me? And then they hired another guy who does construction. They have a team of 3, right? And now they're one of the biggest wholesaling operations in Cincinnati. They'd probably do 20 deals a month. But he told me personally, he's like, he makes less now than what he does then. And so you just have to be okay with, like, these goes back to what the goals that you want and where you want to go. If he's more happy now and he has less time, that's great. But if the financial is what you're mostly after, then that scale might not be the answer.
That's so powerful, Dylan. Alex Mosey said this, one of his partnerships failed is when experience meets money, experience gets money or gets the money.
Yeah. I think it's a Warren Buffett quote originally, but
is it? Yeah. Okay. So Alex from Mosey said it in my book. So if it is, it's true. It's so true because we've seen that. Mike and I personally have seen that, and it happens. We were approached. I remember this. We were approached when we were just starting out the backyard homebuyers like model by a pretty experienced person that was investing in apartments as well and wanted to bring us on. And it was kind of exciting. It's like, oh man, this dude's a big baller. Like he's written a book, you know, like guy knows some stuff.
All this very big name. Yeah.
He's a very big name. And what it turned out to be as we kept having the conversations, because Mike and I were a little bit slow on it. Like, and what we found out was like, this dude just wanted to basically ring us out and take us, and we would have made less money. And it was the best decision we could have ever made, is walk away from that. And at the time, we also had another partner that we were working with, which we walked away from as well and voted off the ship. And that completely changed, but that wasn't the experience meets money situation. But we also have personal relationships with people that ran into the same situation. A very experienced person or team comes in and says, I want to work with you, new person. And you usually go and
you have to ask yourself, why are they approaching you? Like, what is in it for them?
Yeah. Who's getting more leverage?
Yeah. And on that note too, of that third partner that we fired, that was a funny situation as well, because for basically where I think people really get in trouble in partnerships is during like the honeymoon phase. We'll keep it on the relationship sort of connections. Everything was going super well, and he's super into it. And we started making like actually pretty freaking good money. And this is also another thing that I've heard. I think it's also a Hermosi thing, since we just fucking jerk off on his podcast all the time. So he's saying one of the issues that people have when they start with partnerships is this is a common thing where people say like, well, we're going to be making so much money that doesn't really matter. And he goes, I'll tell you what, from personal experience, it really does fucking matter when someone's not doing shit and you're writing a $1 million check every single month.
Yes.
Right. And we were not that big by any means, but we did have a partner who, by all intents and purposes, started off awesome. And then for some reason just like fell off the ship, but we were still paying him every single month. And the big sort of like event I say that showed the big problem. I went on a trip. I went to Africa. It was this trip my wife and I've been planning for several years. Went on this, I got back, and Dan was like, bro, I don't think I've heard from him the entire time you've been gone.
Like a month. Yeah.
He had been like MIA for like 30 days pretty much.
Yeah.
And so we're like, well, I guess we got to fire him today. Yeah. And literally it was like first day back at work. We get on a call. He actually shows up for this one. and Dan's fucking late to the meeting that we're going to be voting him off the island. So I'm
Always.
sitting there for 10 minutes making awkward small talk with the guy whose head I'm about to chop off. And then Dan hops on and we're like, okay, so we've decided that we are going to be removing you from the company. We're going to do a vote as per our operating agreement. And here's the thing is we were versed enough that we knew what we needed to do in order to like deal with this bad situation. And then Dan and I did a really cheesy little like 2-1 vote. Okay, cool. You're out. And because we had established what that looked like already through our operating agreement, that was the one thing that we did well. We were basically able to just give him a third of the cash that we had in the account. And we said, cool, see you later. And it was that simple.
And it was super amicable. Like, I mean, he didn't, I think looking back, handled it just fine, right? Like it was just like, that's what happened. It's the operating agreement. It was all lined out. We've done it. We did that recently and did a vote with the partners Mike talked about earlier. And it's just like, hey, well, we have, you know, the majority share of the company and the majority votes to shut down the entity. And that's, we've done that a couple of times. And then we typically will restart the entity if we want to keep the business going and just keep operating in a new direction without that person.
Yeah. I think something that kind of ties into this too is Mike and I had a conversation offline the other day and I guess Cody agreed to this too. The max that I think a single operator can do is what, 3 to 4 deals a month. So if you're
to do them well, you can probably do like a little bit more, I'd say, if you were like very organized. But that seems to be about like,
and you had no employees at all.
Yeah, if you have 0 employees, you're doing just to give it a little bit more context, you're doing full pipeline management. You're doing all your administrative stuff, your marketing, your bookkeeping, your data, you're doing everything else. You're doing all your acquisitions. You're walking all your appointments. You're doing all your TC. You're doing all your disposition. You're basically a one-man show across the entire thing. As you carry those deals through that pipeline, 3 to 4 seems to be about the ceiling for most people. I bet there's a couple that could get to 5 to 6 if they were like on it, but it's going to be a stretch.
Well, if you're one of those people and you're listening, you can come on the operator show.
There, seriously.
Right, exactly.
But that's just like, so let's say you're making 15,000 a deal. You can almost reverse engineer, you know, what your max could be as a single person with either A, not bringing on a partner or B, bringing on other team members.
Yeah. That's great. That's a great point.
It is. I mean, and funny thing is too, is if you think about the people that we've interviewed on past Monday shows, or like people that we know that are good operators, they seem to peak out at about that $400,000, $500,000 a year number as a single person operator,
which is great.
Yeah, totally. But then, you know, when you bring in the partnership now, say you can double that number, or I would say like realistically, if you bring in an additional person, bring in a team, you can probably increase that number more than 2x. It'll be 2 to 3x. Now you're making more revenue. You're going to make more money if you can keep your profitability up. Your margin's the same. You know, and like the funny thing is too, is on the piece of partnerships versus staff, the most money that Dan and I ever made was back when it was literally just us and an acquisition manager and a lead manager / TC. Because like our margins were super high, our overhead was very low, but we learned that going from that, we went from being able to just kind of be us to doing 5 to 6 deals a month. All of a sudden we were doing 10, 12, right? And we were carving off bigger deals too, because we had people whose dedicated job was to get larger margins. And we weren't basically just settling like it wasn't, it was just us because we needed to be more efficient. And then as we have grown over the past couple of years, our top line has increased a lot. But our EBITDA, our profit is lower just because we've brought on more overhead, but it gives us more flexibility, right? We've been able to start collecting keys. We've been able to get involved with Scale, which Scale now produces its own income, which has added to, you know, our top line even more, just like as a partnership. And that's where the opportunity comes in, is like, it gives you that trade-off. And one of the, I don't remember where I heard this, but this concept that like when you are bringing in staff, you can't expect them to be perfect, but what you can do is you can expect to trade 80% efficiency for 80% of your time back.
That's an interesting comment, because like I have like I believe that, and then but then you hear these other people, and this is a good conversation of how you do this. Other people are like, well, you should be hiring people that are better than you. How are they going to do better than you at that role? And so like for example, like if you could hire a CFO, there's a good chance they'll do it better than you if you're not a like finance or accountant person. Well,
you're talking C-suite level though, right? I do think you should be hiring people that are better than you. So for example, when we brought on our first AM, she was definitely better than us at closing, right? And she brought immediate value to the company. like you can find people that are better than you at those specific skills. I think that the challenge entrepreneurs have is they try to look at that from like a holistic perspective. They're like, I want to hire, like I'm in the worst team in the league and I want to hire fucking Tom Brady. It's like, that's not how it works. What you need is you need that one guy that's faster than everyone else that you currently have.
Yeah.
Right?
I think to add to that is like, you have to respect the boundaries. If they're an employee, they're not an owner of your business. So they're going to do employee things and work like employees. Now, does that mean there's not employees out there that are willing to go the extra mile? Totally not. Like we have employees like that. Like there are employees out there that kick ass. But when you talk about the 80% efficiency thing, they may not be as perfect as you in all aspects. And you shouldn't expect them to be working all 24/7 like you normally would. So that's where you're going to get 80% of the efficiency out of them as if you were doing it. Because you'll just figure it out because it's your business.
Correct. And also too, the people that you are going to hire are different when you're a small business than when you're established.
100%.
Right? Like even if your business doesn't necessarily grow exponentially over say 4 years, when you have 4 years of operating experience, you're going to be able to attract better people because you're going to have a track record. So right. True. And people that are, I would say, more serious employees, they are going to care about that a lot more. I mean, we recently hired a couple sales reps for the like the Scale and Simply Lead side. And one of the most common questions that I got during interviews was how long we've been around, right? Which I thought was very interesting. And, I've reflected on that. And I'm pretty sure it's because what happens, you get a lot of people that go into interviews for a company that's been around for like 6 months that might not be around in 6 months. But the fact that we've been around since, early 2020, late 2019, that means a lot of people. They're a lot more likely to want to invest their time in your business.
I just hired that EA, and when I was going through the interview process, it was the same thing. Like, how long have you been doing this?
Like long enough.
Yeah. And they just want to make sure it's stable. That's all that they don't want to be looking for another job 6 months from now.
See, and that's a thing to keep in mind, right? Is when you're hiring people, what we started with partnerships, now we're on hiring, which I think they're very related. When you're hiring people, recognize that the vast majority of humans, what they value more than anything is stability. Right. And those of us that are entrepreneurial, we don't always understand that because we desire growth, we desire challenge, we desire opportunity. Most people don't want that. Most people are perfectly happy if they have their bills paid and they can go home and they can watch Netflix, they can go on their one vacation a year, they can go to their kid's soccer game, right? And they don't have to worry about, paying for food or paying their rent or whatever. And it's important to keep that in mind. And that's why I think that there's this, it's kind of like outdated, but that old notion that like when you reach like $85,000 a year or whatever, like your happiness doesn't improve anymore after that. Now I don't know what the modern number would be because I feel like that was years ago. They said
like
that
400,000 for inflation,
probably
2 billion.
But the funny thing is like depending on who reads that, right? If you're a driven person, you're like, what the fuck? 85 grand? Like, what would I do if that was all that I made? But there's also a shit ton of people that are like, man, if that was what I made, I would be freaking stoked. Like if me and my spouse made $85,000 a year, we would be set. We could just do our thing. And that is how 99% of the world thinks.
And there's some security in like knowing what's going to happen next and where you're going to go and all that sort of stuff. And that's what people are looking for in a company, right? They want that comfort. And part of that is them interviewing you while you're interviewing them, right? And so if you can't bring that to the table or you can't at least sell yourself, you're going to get less quality employees. And that's where we always talk about, like, you need to practice interviewing. Like if you're thinking you need somebody because you're struggling in a part of your company, you're not keeping up with the work, like start posting the job now, start interviewing. Even if you don't have a company, I don't know, just go interview, figure out what it feels like to be a business owner and start doing that stuff. Like there's real value in it. And then you'll figure out that you might suck at interviewing and you need to get better so you can attract top talent.
Yeah. And one thing too, just to bring that back to the partnership discussion that we started with, it's a very important thing to recognize when you have a potential partner to make sure that they are not one of those people whose happiness is going to peak at $85,000 a year,
right?
Because they will never be with you during the grind and the hard parts that are necessary to grow a business. And the funny thing is too, is there are a hell of a lot of people who think that they're entrepreneurial. They just don't realize they're not yet because they haven't been put into a situation where they either need to figure it out and thrive or they need to take a huge step backwards. And until that happens, a lot of people don't really know if they have what it takes.
Totally. And it's
along
okay if your
those.
goals change too, right? Like as partners,
Exactly.
like
Well,
your goals
I'm
might
glad you
change.
said that, Dan, because
Yeah.
I want to ask you guys about this question. We said at the beginning of this that you should have same long-term goals, right? But you also have to have the willingness to change what that looks like. Reflect on your two businesses and your day one. How much different does it look like now than it did then? Like it's probably almost a 180.
The
Oh,
goals.
it's not even remotely similar.
It's not even remotely similar to what you first set out with.
Yeah.
But if someone has this vision of I'm only doing this thing for the long time, then it's just destined to fail. You have to be dynamic.
Yeah, if you're inflexible or have low flexibility, and you're probably never going to be a good partner. And there's those people out there that they're like, this is what we're doing, this is how I'm doing it, and that's great. You're probably going to have a struggle to have a long-term partnership with anybody because you're too rigid. For us, like our goal, what was our initial goal, Mike? Was it to buy like 40 properties, like 40 doors?
Yeah, I think it was like 50 properties in 10 years. Like
that's what our goal was.
Yeah.
So then we did that in like a year. And so we were like, okay. And we were only 100% mindset of passive income. Like that's where I was at. That's where Mike was at. Like, what if we had 10K a month coming in each? Like that would be so sick. Now I would say we don't really pay attention to passive income as much as we do like income and then building a business. And now our goals are more around building a broader business and what that looks like from an income standpoint. And we've just evolved too. And I think as a business in general, you need to evolve with what the market's giving you. And we've kind of done that, and we've kind of changed our goals together.
Well, and you learn new things along the way. Like, and you just stack those skill sets on top of each other as it goes.
Exactly. Right. And you say like evolve with the market too. How miserable are the people that are purely focused on passive income right now with interest rates and everything else? It's a terrible place to be. But those people that were purely focused on that and never learned how to make money, how to produce revenue, they didn't adopt their skill set. They're a less skilled person, right? They are going to be less successful over the next, who knows how long. While the interest rates stay against their favor. So
I wanted to ask you guys one other question. It kind of relates to hiring, but also partnerships. I've seen in the GoBundance forums, people talk about how they compensate their A players. And there's always the discussion of, a low equity position. So they're owner and they have that, ownership feeling, or they do like a revenue or profit splitting, like with their employees. Have you guys ever done anything like that? Or do you have opinions around either of those models?
It's challenging because we've been trying to, so we have several people on staff right now that, have, I would say like unofficial ownership in the business, mostly because we haven't figured out how to actually structure it in a way that makes sense. Like legally, there are people that have a lot of trust in us and we're not going to like screw them over, but like we do need to figure out the appropriate legal way to do that. I think a big thing that most people need to realize, and this again goes back to people's desires and expectations, is you can have like true A players that will have different desired outcomes of their time with you. And a lot of it's based on their personalities, like their own personal goals. And so like if someone's a very driven, like a high D on the DISC assessment, they're going to be heavily driven by money, right? That is just sort of who they are. If you have someone that's on the other end, they're more of like a C type, they're going to probably be more into like the game, right? On like building something that they find value in, right? And we have two people right now that are very key players in our business that fall into those each end of the spectrum very, very specifically, right? And you'll know exactly who those people are, Dylan.
I would say like, the argument with it is a lot of people think they want equity and they really don't want equity. And Mike and I have we've talked to people about this and tried to figure this out like outside of our business. And what true equity means is ownership. And so that means you give me money when we need money. So if you have 10% equity in my business, when we do a capital call, you need to come up with 10%. And this is where a lot of partnerships fail too, is like 50-50, 30-70, whatever it is. It's like, hey, by the way, like we're doing a capital call. When you're a small business, you might do a capital call. I mean, Mike and I were doing capital calls every single month until we got our first deal. And then we were still doing capital calls, right? Like technically, right? We're just like, hey, we need another $5,000 each, another $5,000 each, another $5,000 each. And that gets much more complicated, especially if you're trying to build a business with an exit. When you have like a complicated cap table where you're like, oh, this person has 1%, this person has 10, this person has 15. Really what they want is profit sharing and maybe some phantom equity, which is essentially when you do make an exit, they'll get a piece of that. But it's not going to complicate your cap table. It's not going to dilute any potential buyers' shares in the business. They can still buy it. And these people will get then a piece of that. And then you as the owners or the founder still maintains all decision-making authority, all of that sort of stuff. It's just that they're working towards a bigger exit or a bigger profit share.
That makes sense.
Yeah. And also too, you can probably pay people less than you think you need to. right? And that's an important thing for people to realize. And not that necessarily you should underpay people, but the thing is once you start paying someone a certain amount of money, you can't go down from that.
Yeah.
And so it's an important thing to realize you're looking at business growth, what exactly that's going to look like.
Totally.
Okay. And, you know, I think that a lot of people, they think that in order to get an A player, you need to be maxing out their salary or doing all these different things, when realistically there's probably like a middle ground that would be better.
Absolutely. Yeah. You're better off like providing a long-term vision for them when you bring them on and saying, hey, this is where I'm starting you at. Here's kind of the tiers of what I think your bandwidth should be for this role. And here's my plan to get you there, but you're going to have some milestones you have to meet to get those increases in pay or profit share or whatever it is.
Yeah, exactly. And also too, if you're like, well, I don't think I can get them to work for me without paying them X amount of money, that's a leadership problem. And you probably need to learn how to incite excitement through your vision, what you're trying to build. Because if you can get someone to believe in it or like what you're trying to do, though, they are going to be more likely to work for like less than like the top dollar. And if not, then fuck that person. Go find somebody else. Like honestly, like they're not a good fit for you and your business at this time.
Yep. Agreed. So
cool. Right on. So I guess just to wrap it up, bring it full circle with some actionable stuff. When it comes to partnerships, do not partner out of fear. Do not partner out of like, it'll be fun, they're your friend, whatever. When you are going into these partnerships, make sure that you guys have complementary skill sets, that you have the same vision, that you guys are willing to go through the same stuff, both in like workload as well as like how much time you're willing to commit to everything. Set up the exit strategy for if things go bad, which they will ultimately happen for the vast majority of partnerships, unfortunately. So it's very important to make sure that that's all teed up appropriately. And then realistically, most people should not be looking at partnerships. They should be looking to hire out for the skill sets they don't have. And that will make it a much more clear way to grow your business. You'll be able to bring in more specialty people while also being able to keep more of your profits. Did I miss anything in all that?
Nailed it.
I think that, yeah, good, great summary.
Cool. Right on, guys. All right. Well, thanks for listening to today's show. Please share this with anyone who is about to get themselves into a partnership that they are going to majorly regret. If you also have a friend that has like a shitty girlfriend and you're afraid they're going to get married, share this episode. It'll probably be helpful to him too.
Yes.
Because
don't do it.
Let's be honest. It's all the kind of the same thing when you get into the details of it. So anyways, guys, appreciate y'all listening and we'll talk to you guys next week.
See ya.
See ya.